India Bonds presents CNBC TV 18, India's Fixed Income Summit.
We know about Maninder Singh as a superb left-arm slow spin. This is ambidextrous in the way she spun it to her advantage. Thank you very much, Ms. Chima, and it was also a very, very encouraging conversation. Let us hope the industry comes to the expectations of the regulators. But more importantly, we know from 1991 that laws have held us back. And when those laws were cut loose, we saw how India never looked back from the Hindu rate of growth of 3.5%. We went on to 5.5% in the 90s, to nearly 8% in the 2000s. And thereafter, it has been dilly-dallying between 6 and 8%, but certainly so far above the Hindu rate of growth. So a change in laws and regulations can make a world of difference. And that is what it has done to this panel. The representatives over here, NSE, NSE's Clearing Corporation, NSDL, and INX. Welcome, Sriram. Well, we know that there are these emergencies. Well, INX taking perhaps Indian bond markets to even more greener terrain. We have all those people who have given us a platform and who have leveraged the technology to ensure that the bond markets are as transparent, as quick as the equity markets, and that is where I'm going to start. Vijay, with you actually. Do you think that, first tell us the measure. You've seen from your ICICI days and thereafter at NSDL as well, the growth of debt markets after a slow start. Tell us the positive side. How good has it been since you took over? And what are the latest figures in terms of improved debt market participation?
Yes, thank you first and foremost, Lata. Thank you, CNBC team. Thank you, the India Bonds team, for having me on this. Totally my privilege to be here. Like Lata, like you said, watched this market somewhat closely, somewhat from a distance for a long time. And from times, I would call it immemorial, we've been talking about the importance of bond markets and how critical it is for the economy and how important it is for it to scale up and how much we have to do to deepen it. Honestly, I think in the earlier part of this session, Aditi did mention that we are in the early middle kind of a time frame. I would kind of concur with that because particularly from the last 3-4 years, I think the starting point in some measure was the regulation enablement coming from SEBI, the OBPP sort of framework that came. We've seen the bond market finally widen to attract more retail investors. Today we have more than 40 OBPP platforms, which is very heartening. We've started seeing number of newcomers coming to the
Those are the numbers markets. I want from you. What do you see in terms of...
So I'm coming to that, yeah. So those have started increasing. We have a total stock. Somebody mentioned 5.5. Those are active demat accounts. But if you look at the total stock of people who have opened, it's about 15 lakhs approximately. We are opening somewhere in the ballpark of about 70 to 90,000 on a monthly basis, new accounts, which is very heartening because if we had this conference maybe 3-4 quarters back, this number was approximately 50-60% of that number. So in the last 2-3 quarters itself, we've seen some scale up, maybe 4 quarters, 3 to 4 quarters, we've seen some scale up. So I clearly, and when we talk to people who are in this business, the OBPP business, we hear a lot of excitement. The numbers they talk of is not 30% growth, 20% growth. They talk of 4x, 3x in a year's time. So the excitement is palpable, and I can completely relate to the emphatic future projections that both Vishal and Aditi spoke about. Similar numbers are coming from, similar sentiment is coming from others. So I think from a positive point of view, knowledge is improving, access is improved. I think the whole infrastructure setup of behind the OBPPs has started improving. Technology has improved access. The most important factor, apart from regulation, technology, access, is trust. People, I can clearly see finally some element of trust because things are becoming more real time. He's able to see his portfolio. He's able to, to some extent liquidate. He gets quotes on a regular basis. It is becoming more equity-like, which has led to so much of growth. So I think on a positive note, early, mid-morning kind of session where we stand.
I don't want to throw cold water on your numbers, but since you said that it is the last 3 or 4 quarters that you have seen the daily...
I would say from 2022-23 onwards, the journey has started, but it is regularly accelerating.
You're taking away my joke. Okay, my point is that in the last 3 or 4 quarters, the equity Nifty index is 10% lower compared to 4 quarters ago. And that may perhaps explain why the number of demat accounts in bonds have gone up by about 50%. From whatever, 6,000 numbers to about 10,000. I mean, I'm just guessing that one of the reasons why bonds become interesting is when some rival instrument isn't giving you the returns that they would once give. But Vikram, since as clearing corp, you would be the last word in terms of telling us whether the technology is finally full and complete. Would you say it is now as frictionless a market as in equities? Or do some one or two things remain to be done?
So, Lata, I think at NSE we've always believed technology is not an impediment, and somebody used the words enabler. I think that's what it has been over the last 3 years. From the way the structure is there currently, and the way we've been growing and we've been handling the volumes and transactions, as well as agile in terms of integrating the retail OBP platforms, I think it's there. It's all about scalability right now because the way we've seen the volumes grow, specifically if you look at the last 2 years of post-OBPP era, where now on an average we see around 7,000 trades daily, and at peak we've handled around 31,000 trades. And we would firmly like to believe that our capacities currently is to handle at least more than 2 times of what we are. But in the next 1 year, from a technology perspective, what we aspire is that at least from the peak that we've seen, we should have a 5 times capability in maybe say the next 6 to 8 months, because the way Aditi keeps pressing on the kind of growth, and we've started seeing that growth actually, is phenomenal. 2 years back, on an average, we used to have around 500 maximum daily trades. Now on an average, about 7,000 at NSE clearing, out of which 95% coming through RFQ, is a phenomenal amount of growth.
In terms of time, clearing, is the end-to-end absolutely frictionless?
It's fairly
or
very
do you think
smooth.
there's something that technology has still to deliver?
I think the way we've integrated over the last couple of years, the entire technology stack, including UPI framework, let it be RTGS, NEFT of RBI, it's a seamless process now, where an OBPP platform allows an investor to actually transfer the funds, us to reconcile, and maybe maximum, I think Vishal, you mentioned 5 minutes, but I think it may be even lesser than that when an investor is able to. And the biggest benefit is we are, people equate it to equity galloping, but I think it's the corporate bond market where the settlement is continuous. It can happen trade by trade once you get the other side, whereas in equity you have to wait for the next day for the settlement to happen. Technology, I think, is firmly there. The bed is out there, and I think now we are waiting for that distribution framework which will take the volumes up, and we'll have the capability.
Okay, I'm waiting for something else, and let me ask Sriram that. It is still a AA plus market, AAA and AA plus market. Do you think, what holds back to bring it down below that? After all, in equities, you have the entire range of companies. Even those reporting losses and negatives for years are still traded. So what would you say is the missing link to get at least to A and BBB plus?
See, if you look at this space from an outsider's perspective, you compare the rest of the world with India, there's one thing that strikes you. There's no requirement for credit rating in the US. There's no requirement for credit rating if you want to list your bonds in the UK. There's no requirement in Hong Kong, Singapore, Japan. But we've had always this requirement that if you want to list your bonds, you need to go through a credit rating. Now, I'm not saying this is the reason why smaller companies
Exactly
are
the
not coming
point.
to.
I mean, it is because there is a rating requirement that at least you have so many. Perhaps, if you said unrated people come, do you think that is going to increase participation in liquidity, or will it actually deter because you're not even sure? That,
No, so I'm looking at it in another way, which is that the psyche of the investor in India has got tuned towards the credit rating. And therefore, without credit rating, oh no, this could be risky. That's how people look at bonds in general. Whereas in the US, companies are heavily encouraged to go and list their bonds. Don't worry about the banks. The banks are there for short-term lending. Bonds is where you need to get your long-term money. That's how the inherent nature of the beast is. So therefore, I think we missed a trick somewhere by insisting on credit rating. Last year, I looked at some other markets as well. Russia, for example, no credit rating requirement. So I think the psyche of the investor is one factor to take into account. Secondly, I think we've never allowed the retail to face off with the institutional clients for some reason. The corporate bond trading always seems to be happening among players, and the retail is simply kept out. Only now in the recent couple of years, we've seen the OBPPs slowly coming in and explaining what these corporate bonds and the debt-focused instruments can bring to a portfolio. So that's the other aspect that we probably need to look at. Thirdly, I think we need to think about how technology can make this happen, all of this happen, and make it very seamless. Investing in bonds looks like very threatening. You look at a company, they have so many issuances. It's not like equity where you go buy Infosys, that's it. There's just one ISIN. So this concept of investing in bonds itself is not seen as so easy to do. You might make a mistake, you might choose the wrong bond. That's the kind of complexity. Therefore, even the RFQ platform, although it's a great initiative, it's still struggling. It's still being used like a reporting platform and not really a platform that should get better deals for an issuer of bonds.
So, Lata, if I may, just add a little bit more to your specific point.
Are you sure that this is a rating requirement issue?
Yeah. So let me tell you what we've observed in the last couple of years, more recently actually. We saw the numbers of corporate bonds outstanding. That's about approximately, let's say, 55 lakh crore. 97% of that is AA and above. So you're right in saying that we have gravitated. But if you look at why it has been AA, it is largely dominated by the penchant of the institutional investors in the historical past. And that's been gravitated towards the AAA, AA plus kind of a family. But as retail has started improving in the last few years, we've started seeing a very interesting trend. And 2025 FI gives a very interesting outlook to what could potentially hold as a trend going forward. Out of the total issuances that happened, 16% were AA and below AA actually, which means on stock.
Come again with that number?
Sorry?
Come again, number?
16%. 97% is AA for stock, but new issuances 16% is coming below AA.
Below AA, okay.
Which means if this continues over a period of time, I think the demand, which means that clearly the
and they come without any credit enhancement, first loss,
so
nothing?
they are actually below, so all included. See,
all
credit
included,
finally
it's below
comes
AA.
below AA. And one of the reasons is because I think in the thirst for yield, the retail investor is looking for those kind of instruments. While this is something which is an interesting trend, I think as responsible market intermediaries and infrastructure players, we have to be careful to educate the investors that there is a risk associated with that as well. So I think that apart, I think as a trend-wise, one can really expect more participation coming as retail increases in the below AA family.
Absolutely. That's extremely encouraging to know that. I would assume that investors are coming with their eyes wide open. Institutions have a mandate, for instance, insurance companies or pension funds, they have a mandate of not to go below a certain rating, and that explains why it's only AA plus and above that dominates the market. But if retail is able to stomach below AA, then perhaps that is the most encouraging sign of the growth of the market. Vijay, you form a very important piece over here, because I mean, and I want to ring this out if there are any equity guys also to listen. In the last 2 years, when we have seen this huge capital outflow by FPIs, the ones that have been sticky are actually the bond. You've hardly seen, a few $1 million of bond sales, even in the worst of times during the tariff threats. But international bond investors have been sticky. So do you think the doors are sufficiently wide open as a person from the gift city who opens the doors a little wider to international investors? Is everything in place? And do you think that a gush of fresh wind and liquidity for the bond markets will come from international investors?
Thanks, Lata. So if you look at the last financial year, and rightly said so, as we stand in May, the FPIs from a bond perspective have been net buyers and not net sellers as opposed to the equity. And if I was to look at some numbers that I briefly look now, the FPI limits on corporate bonds, if I'm not wrong, is only 20% utilized.
Yes.
Approximately, right? So still there is an 80% room for it to be utilized. That's number one. Number two being that now there is and definitely an yield kicker for these guys to really come in. So there is, the spread is widening, right? Be it and...
Are you referring to corporate bonds? Are you referring to even G-Secs? Even G-Secs, it's only about 20% bought.
It's about 20, yeah. So even on the corporate bond side, there is this yield kicker which is there. So through the VRR route or whatever route, so there is a lot of people who are now eyeing the market to really come in. So there is a significant headroom for the FPIs to still flow in and really come in, right? And thirdly, with the inclusion of the Indian sovereign bonds in the international indices, that's actually been a significant step in the last year that has happened, which has actually slowly started getting the kind of proportion of the FPI investments back into the country. Having said that, is it going to fully open the doors, or there are still things? The taxation is a bigger issue, right? As you in your initial statement really pointed out, that debt is still at the mercy of policy rather than going hand in hand with the policy. So I think so, with all of these things, really, I would say the platform is well set. Some changes in the policy, some parity with the other asset classes, which is far more riskier than the bond market. If there's a parity, I think so that it will open the doors furthermore for all of these investments to come in. And if we need to realize the dream of a Viksit Bharat 2047, which is seen by a Honorable Prime Minister, I think so the inflow of foreign capital into the Indian bond markets for long-term infrastructure building is going to be very, very important. So yes, the door is slightly open. There is a lot more to do for it to be fully open. But yes, there's a lot of room for the FPI flows to really come in.
Okay. I will be asking all of you for one big idea to open the door wider. And I think I can outguess what you're going to say. But nevertheless, maybe you will have more ideas to give. I just want to tell you what I think, or the market worries as problems that show lack of development of the market. Both Chima and Dina have left, looks like. But I wanted them to hear. RFQ. Did SEBI give up on persisting with quotes coming on the RFQ platform? It became a reporting platform. And for a while, SEBI persisted and then allowed it to be a reporting platform. You think insisting that the quotes come there would have been a good idea? Is that the next step that might perhaps widen and make the market transparent, liquid, etc.?
Yeah, I think if you look at some of the challenges which come in the way of growth for retail participation particularly is, you nailed it actually, it's liquidity. What can be done to deepen liquidity? And in a way, I would say both the RFQ and the EBP platforms are very foundational for providing that kind of momentum. Making it mandatory would certainly have ensured that there is more data flow which is taking place, more quotes which are coming, and therefore the opportunity. But I think that said, in the talk of Madam Chima, she clearly spelled out the budgetary-led reform agenda that is getting unleashed. I think that is sounding very exciting. I was hearing it with rapt attention, that frameworks are getting made for market makers and so on and so forth. distribution and so on. I think what is needed is that kind of an institutional framework which is taking care of the complexity of debt capital markets, and she explained it in the legalities of it and so on and so forth. So simply making it mandatory seemingly would give an impression that it's going to help, but I think the issues are far deeper. So a more robust framework that SEBI is now talking about, I think, could be a way forward to take trust along, to take confidence along, to take sustainability along with
Fair point. Actually, Mr. Mittal was speaking to us before, along with Maninder Chima, before we entered, and he was saying how the moment you have DSAs, the moment you have the last mile services, market makers, the markets usually develop for instrument after instrument. I guess when Manisha speaks to him, we will have a richer conversation with us. But Vikram, the extent to which corporate events get immediately reflected in the bond price is still not up to the level of equity. When I'm buying a share, I know if it is come bonus, come dividend, ex dividend, whatever. The corporate event is immediately reflected. That's not the case in bonds. A rating upgrade or a downgrade doesn't immediately get reflected. Or, if there is a restructuring, any kind of event. Is that one big leap that is still wanted?
Certainly, I think the level of disclosures that is there, the rapid speed at which the disclosures happen, and more about interpretation. So equity, it becomes an easy interpretation.
Yeah, that's true.
The moment it is actually disclosed on the stock exchange's website, it's out there in minutes. But I think on a corporate bond, the impact is going to be a very different kind of an impact. So I think that knowledge and the last mile knowledge, when you're talking about retail, see, corporate institutional investors will always understand whatever disclosures are, because they understand the prices start reflecting events as well. And but for retail, it's a very different thing. I think it's not about the disclosure, but I think it's about how that knowledge gets interpreted in the investment decision is something that needs to be worked upon.
Okay,
I would just add, I think all that you said, we are very, very close to that, if not already there.
Yeah.
I mentioned the 40 odd OBPPs who are there. When we talk to them, they've solved the access problem.
Yes.
Systematically, as they get more sophisticated to attract more, all these ideas that you mentioned is on the anvil, if not already in the early days of launch. So it's going to get there.
If it is like next year when the second edition of this summit happens, if we are able to say that these have already achieved, then we are already on the way to. Yeah, Vijay, you wanted to add?
See, actually, what you posed to Vijay in the earlier part, and what was spoken earlier, this market is complicated, right? So when we say that, is that going to be codes that's going to be matched? That we are sometime away for it. If I was to look from a very practical angle, and I have spent some time in this corporate bond market, 20 plus years in the Indian corporate bond market, right? And I have a little bit of understanding of this market, if not really well. We have come a long way, where the markets were extremely opaque. There was absolutely no information available, to where each trade is getting disclosed, reported on the exchange, primary issuances, terms and conditions available. So everybody has an access on the public platform, on the websites of the depositories of the exchange. These are, very easily available, right? Also, the regulator has played a significant role in some of these things, right? Today, we take a PFC as an issuer. We have maybe, 50 odd ISINs outstanding. And if I was to take, say, maturing in 2030, we'll at least have 10 ISINs within the same month, right? So, if there are no intermediaries here, right, and we say it's only going to be an order matching, that's going to be put up, it's not going to be possible. But another 3 years or 5 years down the line, this may slowly start happening. The reason being that the number of ISINs that can be issued by an entity is curbed. So that's come down to 9 or something by SEBI. So slowly and steadily, from about 13,000 outstanding bonds over the next 3 to 5 years, these number of outstanding bonds has drastically come down. And then we will, then say that, okay, for every issuer, we'll have maybe 5 or 7 or 10 bonds outstanding. Then that makes it far more easier for somebody to do this, thing. So we are moving in the right direction, but it's not that we're going to really see that happen, in the very short term. So it's going to be a medium-term exercise, but we are in the right direction.
Okay. I really wanted to start off. Thank you very much for that, detail. We must know that we should not be comparing it with equities all the time. Globally also, it's in so many countries, debt is a hold-to-maturity market. So, let's not jump the gun. If you're making this progress like the two of you are saying, then we are, really getting there. Very quickly, since the clock is warning us, I'm going to forego some of the questions I had on IRFs. I feel very bad that, we have a fixed income market as far as, it's fixed as far as corporate bonds are concerned and floating as far as banks are concerned. And it looks like never the twain shall meet, the way in which you're progressing. But that discussion for another day. Can I ask all of you to give me very quickly one suggestion which we will present to SEBI or to the Ministry of Finance as an ask? Let me start with you, Sriram. Ask.
Yeah, I think we need to popularize the concept of bond index and derivatives based on bond index. That will help people understand the top issuers, and slowly people will start coming in. Derivatives can be a great leveler.
Yeah, derivatives perhaps at a certain level, but bond index definitely. Vikram.
I'll take the liberty of giving two. So
Please.
One, certainly what you mentioned, taxation and streamlining taxation around interest, etc., is important. But more importantly, not so much for regulator, but I think the focus on the way the regulators allow distribution to happen. Allow distribution to happen is going to be very important, because this market is going to be, it is going to require a lot of selling and a lot of explanations to get it into the hinterlands and increase the retail base.
Okay. As media, we accept the responsibility. We'll try and do our best. I thought when you said you have two suggestions, I was going to say I have three. Taxation, taxation, taxation. But Vijay.
Yeah, so you said two things. One is to the regulator, one is to the
ministry,
ministry. Yeah. Ministry ke liye to one single point agenda. I'll stick my neck out and say tax parity. Yes. If it is to the regulator, I would say, the reform around market making that they spoke about, I think accelerating that, more of that.
Yeah. So, okay, already on the agenda, one hopes we can put taxation.
I don't want to repeat, what of these. Of course, taxation, tax parity is something that is a given. All right, but I think so. We are doing a phenomenal job along with the OBPPs. So I think so. What is very critical is going to be the creating and spreading the awareness of the availability of bonds in a very seamless manner. And also, since I'm here, I just wanted to make this point in the interest of time as well. SEBI very recently has come out with a consultation paper, right, wherein they are planning to give the OBPPs an extension of arm to allow them to offer the foreign currency bonds as well. So that is really going to be opening up the channels for the Indian retail investors to also look at bonds beyond the Indian shores. So right, people who are really interested and really looking to diversify their holdings, there's a very good opportunity with the SEBI consultation paper that has come out, to see how the OBPPs can really, lies in and tie up with exchanges like ours, which is there in GIFT IFSC, to see how the, foreign currency bonds can be offered of multiple foreign issuers coming out there. So that's another, very, very interesting milestone by the, regulator that's really come out. But yes, investor awareness and creating that kind of an, seamless understanding of the bond, because bond is complicated, right? So that, because people still don't know what is an yield and what is a return, right? Or a coupon and an yield, still they don't understand the difference. So if, as long as this is really percolated well down, I think so, we've done a good job then.
Oh, absolutely. I mean, for every bond copy that I write or speak, I have to say that prices and yields go in the opposite direction. I mean, that is a necessity because it is a more sophisticated market. Our time is up, but I want to put one vote, one question to vote, since everybody wanted to make that as a suggestion. How many of you think that tax is the biggest obstacle, or tax parity is the biggest ask of the debt market? Hands up for those who agree. Okay, we rest our case. Thank you very much, ladies and gentlemen.
Thank you.
India Bonds presents CNBC TV 18, India's Fixed Income Summit.